Good evening, ladies and gentlemen. Happy weekend to all of you today. Today, we're going to be talking about up, and more up. The market just seems to be on a steamroll higher. We have the bear fuel, we have the catalyst, we have everything, but there are a couple things I want to point out, give you kind of both sides of the story. Now, I did cover this in the last weekend deep dive that, well, we're expecting possibly a breakout in the S&P. We got 52-week highs, so I lost the bet to fatal. So, bygones be bygones. And one of the things is we're pushing up with volume increasing. So as I was saying previously that this latest push up with low volume or a decreasing volume was bad, well, now we're kind of getting the countervailing point to that, whereas the NASDAQ as well kind of just going sideways. Not a lot of excitement there. We actually had a double bottom around the 386 area for it, but if we look at RSP, this pretty much tells a very interesting story. It is a broader market rally and even more clear when we jump over to the Russell. The Russell is the IWM ETF, basically is the ETF for the Russell, if you guys didn't know that. And small caps are now bullish. Basically, I'm saying that because you're above the 200 weekly. I talk about this a lot on the channel. Wait for you get a break above the 200 weekly, which the moving average is essentially the last 200 weeks averaged price. So it's just a representation of that if you guys didn't know that already. And basically when you hear 50 daily, 200 daily, just think 50 days average over time, 200 days average over time, whatever that time frame is. So with that massive volume on the Russell, pushing up higher, breaking to new highs, was a 3% day on the Russell, about 0.5% and then 1/4 for the NASDAQ. So pretty nice rally. Some of the bigger cap stocks are not necessarily being the ones pushing us. It's mainly small cap. So we need to see if this is going to continue because it's going to be a really interesting week coming up. We definitely could get a nice push. We have some news out there, but one of the things that I'm concerned about is the bonds market. But we'll get into that in just a second. Let's quickly recap what happened this week and we'll get into bonds and then we'll give you the biggest winners and losers for the week. And then, as you guys know, I did take a losing trade this week, but winning times and bad times come together. You get a mix of both. I thought we were going down just because the indicators were saying that, but I knew where the line was in the sand. So building permits went up. So people are basically remodeling, doing things. So it's still showing that kind of this mentality of the shelter inflation and shelter market where people are not willing to go to a new house. That fervency is kind of dying down based on new home sales. As you can see here, going down. So builders, if you're in XHB, home builders, that may be something to look at. That this is getting revised lower. If we look at new home sales for October, basically the year-over-year number, previous month got revised roughly 40K lower, and we missed by a significant margin. That's estimated at 50K less than expected. So again, that's a pretty hefty 100K combined hit to new home sales. And just in the month of October, negative 5.6%. So does this mean that we're finally going to see some relief in shelter inflation? Well, if we look in medium home prices across the country, they're just stagnant. So we're going to need a couple months of this in order to really get home prices lower. 2-year, 6, 3-month, 5-year note auctions, nothing notable there. However, if you look at net speculative positions going into the beginning of this week, negative 80 versus 52 before, and we actually get a print this Friday, which was pretty interesting. As you can see, home price index going up slightly, then year over year up as well. So home prices kind of still staying strong because overall inflation is still not vanquished. Shelter inflation being one of the metrics that hasn't even touched anything. Consumer confidence going in higher. However, as you can see here, we had the same exact number last month and was revised lower to 99.1. What do you think this could happen? Give you the 102 number, revise it to 99. The next month, we'll definitely be covering that. And Wednesday, we had GDP. GDP came in 5.2. I don't know how much you guys are believing that. I'm not really believing that, but then again, it is the number. It is what the market's running. I don't necessarily have to believe it to trade it. I can just look at both sides of the story. And last but not least, Thursday, the Big Daddy Core PC. And I wonder if you guys actually caught this, that they revised the year-over-year number actually from 3.1 down to 3.0, just so it would come in line, not giving that super bullish reaction to the market, as they can revise it up until the release of the report. month over month, stagnant inflation, meaning that we basically didn't go anywhere from the previous month. So the situation's not getting worse. However, it is in the area where we're going to start maybe getting some deflationary readings, or possibly start seeing PCs start coming down more significantly. However, core is still above the Fed's 2% target. It would take almost 6 to 8 months, which the market is pricing in cuts in for. So again, cuts are inflationary. When the foot comes off the tiger's neck, the tiger usually wants to go kill the person that had their foot on the tiger's neck, aka inflation rearing its ugly head again. So we have to keep that all in mind, that the Fed's not necessarily, they're going to pummel the economy first to make sure it's unable to have inflation similar to the 1970s and 1980s when they cut rates too soon. Remember, that's one of Powell's greatest fears. Natural gas storages came in better than expected, so bearish on natural gas prices. RIP for anyone that's in UNG, or what was it, UGAS or something like that for the leverage ETF. I can't remember exactly off the top of my head. And what was interesting, on Friday we actually had Powell speaking, so he really didn't say much. He just kind of said more of the same. We're not thinking about cuts right now. And then ISM manufacturing PMI, again, contraction territory, which is expected for manufacturing right now. Not really a conducive environment. And the short positions covering slightly from 80 to 65. So we still have bear fuel in the market. Now, the thing I wanted to cover in this video for you guys before we hop over to biggest winners and losers is bond liquidity. So this is actually in my 401k. Really don't share this on the channel because I really don't do much with it. I kind of just manage my own stuff on the side. However, if we look here, and this is really what I want to bring your attention to, is these parentheses prices. This is the minimum quantity to buy a bond. So remember, a bond has a face value of $1,000. So when you see the $1 million minimum requirement to get this yield, that's pretty staunch, where before this wasn't like this. So people are demanding large quantities in order to transact because they don't want to deal with the losses, or let's say they don't want to deal with the singular transactions. They just want to deal with get me out of Dodge now. And we have to actually scroll for quite some time before we even get down into something sub $350,000 for bonds. So as we can see here, we're getting into the 100,000s, and I have to keep going for quite some time to even find one that a retail trader could get into, where you usually see the singular ones. Now this is in after hours trading, so, or when the market's closed, but you see how long I had to scroll to get a 5? That's $5,000, guys, and not a huge amount of them available. But look, your yield is 4.6 versus what previously, which the bigger players are able to take advantage of, 5.3. So these market participants, the retail traders, can't fund this. This is only large institutions can buy these bonds. Again, remember, bonds are a crowded trade, as we've been covering on this channel. And as you can see here, the bond market is bouncing pretty nicely. We'll get more into that in the key levels section of the video, but I did want to bring that to your attention that this is showing signs of lack of liquidity. When I preach on the channel, don't buy penny stocks, because the problem is you can't sell it. AK here, in order to even sell bonds, you need literally 50 grand to 100 grand. Now, I know that there's some older people out there that will view this channel and probably have 100 grand, 200 grand in their retirement accounts. Well, for those that don't have that are small fish, and average day Joe is a small fish, and some of you guys watching this channel are small fish. So guess what? We don't have the ability to go spend 350 grand on a singular bond. That's just not going to happen. So the liquidity on short-term debt is horrible, and we will get more into that and why it's important in the key level section of the video. And then obviously when I cover the yields, we'll talk about that. But first, Fatal is going to give you the biggest winners and losers, and I'll be back for the key level section of the video.
As the weeks pass, I believe that I'm going to be proven correct with my statement that we are going to reach 52-week highs on the S&P 500. You can see right over here, 52-week range. We are less than 1,000 points away from reaching this 52-week high. And as of this past 5 days, we are up 1.04%, leading more towards gaining this actual goal. Looking at this past week's earnings, we could see that there wasn't really much on Monday. Tuesday, we had companies like Scotiabank, CrowdStrike, Workday, Intuit. On Wednesday, we had Foot Locker, Snowflake, Salesforce, and Dollar Tree. Thursday, we had Kroger, TD Bank, Ulta, and Dell. And on Friday, we have BMO and Genesco. When taking a look at next week's earnings, we could see that on Monday, we got companies like GitLab. On Tuesday, we got Neo, AutoZone, and SJM. That was going to be a fun one. On Wednesday, we got companies like Ollie's, Vera Bradley. I'm going to have to tell my wife about that because she loves Vera Bradley, GameStop, Chewy, Campbell's. And on Thursday, with a big one here would be Broadcom, Dollar General, Lululemon. And on Friday, we got Johnson Outdoors and Hello Group. Jumping now into the heat map, we can see the majority of this gain was brought up by the financial sector and the real estate sector. But jumping now into the technology sector, we got over here the worst performer being the company Broadcom, losing almost 5%, and the best performer was the company Salesforce, gaining 15.88%. Communications didn't do so hot, with the big ones like Meta and Google actually falling. However, the worst performer was none other than the company Meta, alright, losing 4% essentially. And on the best performer, we got the company Paramount Global, gaining 11.05%. The consumer defensives was 50-50 on most of these. However, we can see that there were a couple companies that were in the green. Worst performer was the company Hormel Foods, losing 4.28%, and the best performer was the company Dollar Tree, gaining 7.53%. The healthcare sector, as you guys can see, is very green, all except for a handful. Worst performer was none other than the company Cigna Group, losing 6.54%, and the best performer was the company Illumina Inc., gaining 11.64%. The financials are looking interesting, as you guys can see right over here. There's a lot of green, especially in the regional banks, but worst performer was none other than Arch Capital Group, losing 4.58%, and the best performer was the company Synchrony Financials, gaining 13.41%. The consumer cyclicals is also very much in the green. Worst performer here was the company Las Vegas Sands, losing 4.33%, and the best performer was the company Norwegian Cruise Lines Holdings, gaining 14.27%. However, guys, we have to mention companies like Ulta gaining 13.82%. We got BBWI gaining 12.85%, and International Paper gaining 12.94%. The industrials is mostly in the green. In fact, the ones that lost didn't even lose that much. Worst performer was the company Copart Inc., losing 1.34%, and the best performer in this whole entire sector was the company Generac, gaining 8.42%. The real estate sector is all in the green except for two companies, and those two were Welltower Inc., losing 0.2%, which is nothing, and the worst performer was Weyerhaeuser Co., losing 0.63%. Aside from that, guys, everything here gained. In fact, the best performer was none other than the company BXP, gaining 17.82%. But also take a look at this, CCI 14.47%. Remember when this thing was sub 80 just a few weeks ago? Well, there you have it, guys. There you have it. Hopefully y'all bought at that low, and if you did, congratulations. The utility sector, as you guys could see, very green. However, a few of them were in the red. We got the worst performer here being the company CEG, losing 3.21%, and the best performer was the company AES, gaining 7.09%. Looking now into the energy sector, this is actually somewhat 75-25 in the red, right? Majority of these are actually in the red. Worst performer was the company HES, Hess Corporation, losing 3%, and the best performer was the company Phillips 66, gaining 9.33%. And when taking a look at the basic materials, worst performer here was the company CF Industry Holdings, losing 2.62%, and the best performer Nucor Corp, gaining 8.43%. So as it currently stands, guys, I think that we're still on track with getting 52-week highs on the S&P 500 by the end of the year, especially this upcoming Friday, which we have job numbers. Then the following week, we got the FOMC meeting, and if the Fed says that they're going to do another pause, most likely this thing will skyrocket into the new year, giving us a Santa Claus rally. So that pretty much does it for my section. Take it away, Mike.
So like we covered in the beginning of the video, we did have a breakout on the S&P, NASDAQ kind of staying flat, but let's start off with the S&P. As we can see here, it is a weekly breakout. So let's remove the levels and then set up our new levels for the week. You guys can do this on your own charts. All you got to do is go to the weekly, snap the highs and lows of the week, and that establishes your range. The low is going to be our support or breakdown bearish, and then above is going to be our breakout bullish. I usually put it in red because I'm more of a bear, so for me it's like my stop loss and then bearish. However, I do keep in mind that I'm going to be looking more bearish this week, or sorry, more bullish this week, because we are consistently breaking out, flying out, volumes going up. So I really think we have the ability to continue, especially with small caps breaking out. For the S&P, it's going to be 459.65, very close to where we closed on Friday, and 453.34, which was the bottoming of the week. So if we come back down there, we definitely could catch a bounce. So I wouldn't necessarily throw it out of the question of another move up higher, or we could just gap and go this week. So be on the lookout for that. A pretty simple trading strategy for this week. And as you can see here, we're starting to tackle near all-time highs. The S&P is roughly at this point in time away by 1.63%. So nearly 2 trading days could establish a euphoric run, especially if we breach that level. The NASDAQ, on the other hand, has the same levels this week. However, we're going to adjust the upper range and the lower range to basically the wicks of the week. Now, a broader range, but really the same exactly like we had previously, 385.80 and 394.24. This is the one that I'm actually going to be looking for the bullish play. Now, why do I say that? Well, tech has been suppressed this coming week, and really, it hasn't really led, meaning small caps led, S&P led this week. So now we definitely could get a broader push in the markets by tech. Tech could kind of be like, okay, I'm relaxed now. Let me push my 2-3% up higher. We definitely have the catalyst for it this week. So we'll get into that in just a moment. But looking at it from a chart perspective and just trading on the chart, yeah, we definitely have a nice push potential. However, if we break 385.80 and close below, then I'm going to be looking different. I'm going to be looking for this gap fill down here, and then the 50-day moving average afterwards. Pretty simple as that. And I do say closing basis, guys, just because I really want to see the close of the day below that, not necessarily us breaking it, because then it's a failed breakdown and then I don't completely muddies the water for the strategy. You want to close below these lines to confirm, similar to how the S&P on Friday closed above the previous week. So we're confirming the breakout. We're probably expecting continuation now. NASDAQ hasn't necessarily done that, but then again, could gap to it and then keep pushing. That's a scenario I'm going to be looking at. RSP, well, this is just, equal weighting our S&P. We use this to determine basically our range for the week, and well, we close probably within a cent of the upper range on the week. If we snap it right here, yep, 4 cents, guys. So we close within 4 cents of the weekly range. So pretty massive bullish move on RSP. Definitely could see continuation, but I do see an area of resistance that was previously here that we could have some trouble now. However, we are closing right at it, so definitely could get that rotation and rotate all the way up to 152, 153. So nice, basically, what would that be? 2% move expected, 1.4% on RSP before I think we hit resistance on it. And last but not least, let's just take a look at the Dow. Well, the Dow is just basically going to sky high, and if that means we are now at new all-time highs for the Dow Jones. I really haven't covered the Dow in quite a long time, but that means that we're really pushing those all-time highs now on the other indexes. If Dow is able to do it, break above the 2022 slump, it actually broke 2-3 days ago. I'm shocked I didn't see more news articles about that, but I do not like the parabolicness of this move. It's one thing that kind of leads me towards a longer term bearishness. If we look at China basically dumping Japan, kind of just going in stagnation since July. So is the broader market going to lead? Is the United States going to lead in this broader market? We have to see. But again, recapping the levels for you guys this week. 394.24 breakout for NASDAQ, 385.80 breakdown for the NASDAQ, S&P 359.65 breakout, and then 353.34 as breakdown or failed breakdown to recover expected for this week. And last but not least, let's just jump over to the Russell. Well, similar story to the Russell, similar story to RSP. As we can see here, the weekly range, I'm actually going to keep the low where we are here because it is more of a true support for the Russell. So really 185.13, I said he closed above 180. That's what you want to do. And we were touching it. We were touching it each week. I saw it as weakness. However, the bull stepped up and basically with volume confirmed price. So yeah, it's just a beautiful push on the IWM. 176.91, and really the line of sand's 181.70. You do not want to close below the 200 weekly again because you struggled so much to get back above it. That means this should now be your new support. You want to close above it. You don't want to lose that level. That's what I'm going to be looking on the Russell. And then last but not least, let's jump over to VIX, dollar, and yields. Starting with the dollar, just a poo-poo train all the way. Massive push up, slamming right back down below the moving averages, 200 far below us here, rejecting off of the 250 weekly. So again, those areas, critical importance right there. No support found, violated it completely, bearish on the dollar as I see it. VIX. Now this is where it gets a little more interesting. And we'll talk about a trade that's being popularized right now in the debate section that I think is the dumbest trade in existence, of trying to short volatility. I'm like, that just gonna, just horrible. But we'll get more into that later on, guys. So VIX holding that $12.80 level. Now, it's not showing strength here. However, it looks like it could definitely push up higher in these levels. But then again, I'm also saying the market is probably going to push higher. What could be the catalyst? Well, we'll get into that just shortly. But VIX is going to be a crucial level. Do we start breaking that 12.5? That's going to be the line in the sand for me. 12.8, just like the general one I have here, coming off the previous lows, but VIX isn't showing the most amount of strength here. However, I do think we could head a pullback in the markets, kind of calm down maybe the S&P a little bit, or go sideways, and then VIX kind of just break down. Not a lot of people wanting to buy insurance into the end of the year, so it is a little bit of seasonality. And I know we haven't covered oil on this channel, but still bearish, bouncing below these moving averages, looking at $70 as a price target on oil broader. So good for inflation, not necessarily good for the broader economy because it's a signature of slowing demand, as we saw with the ISM manufacturing and everything. But really, the big news is bonds. 30-year crashing down on the yield, 2010 to just pile drived when Powell spoke. Now, why is this important? Well, there's two things I want to share with you guys. And if you guys did not get anything from the video so far, I apologize. Throw it down in the comment section of how we can improve it. But if you don't take anything away from this video, take this bit of information, guys. Let's jump over the yield curve. The yield curve is starting to finally come back down. Great. Not if you think that's a good thing. That means Armageddon is slowly approaching. When the blue line crosses the white line, that is when the recession occurs. The inversion of the uninversion of the yield curve is when everything falls apart, especially in the bond sector. Like we covered in the beginning of this video, the liquidity is completely drying up in the bond market, and I have more evidence to show you, which is the reverse repo. I thought this thing was going to go sideways. No, we're draining it even worse now, guys. This thing actually had a bounce when bonds were falling to 900 billion and then sharply declined to 768 billion. That is probably the sharpest decrease I've seen. Now, does that mean we could just go stagnation here and then go kind of come down, reestablish the trend? Yes, but this is alarming. This is very alarming in the near future. Not saying into December, not saying into January. I'm saying basically February, March timeframe. This is alarming because in March, we have the short-term bank lending program that's basically expiring, and the Fed has not indicated in any way, shape, or form that they're going to renew it. So all your paper losses, banks become real losses, bank runs become a thing again, and that may be their plan to basically kind of quell all these banks to conglomerate them into one, aka JP Morgan. But again, this is eventually going to run out, guys. By June, this reverse repo, if it continues on the trend, will hit zero and we will start getting failed auctions. We're already starting to see the cracks in the dam with this. When I can't buy anything cheaper than $350,000 of bonds on a single transaction, well, there's a dang problem, because a couple months ago, I could have bought one bond whenever I wanted, at whatever yield, at whatever strike. So this is very, very alarming, on top of bond yields falling off a cliff, which is good. You know, everyone's going to say that's good because banks can now transact in this. Yes, but you have this ugly yield curve that's going to come rip your dang face off. But enough of that. We're going to talk more about in the debate section of the video, but I just really wanted to share that with you guys about bonds. I have not seen liquidity drying up in bonds until now. This was an eye-opener for me, and it'd be really, really scary if that orange line came to fruition. That's my theory, which is a double top of .com N08 average length of when everything uninverts, and if you just draw a slope line to it, maybe I'm right, maybe I'm wrong. Again, this is a theory. Don't base your trades off of it, but you definitely don't want to cross that red line, because that would mean you're going to get something worse than the Great Depression on this uninversion, and no one wants that. So again, let's jump over to what the news for next week's going to be. And well, we got jobs on deck this week, so it's going to be pretty interesting. Monday, we got 3 and 6 month bill auctions. That'll be a little bit interesting. We have Tuesday, S&P Global Services PMI, and Jolt job opening. So let's see how many jobs are opening. Are we going to get a bullish run into the holidays? And this was October, so you're setting up for Thanksgiving and stuff like that. So it's going to be pretty interesting there. And then ADP, I'm not even going to pay attention to that because, well, first and foremost, that has been so wrong so many times. It is not even funny, guys. So not even going to pay attention to it. And as always, we have Thursday initial jobless claims. They don't have the expectations yet. However, Friday is the big daddy payroll. Non-farm payrolls expected to go up. They're indicating already non-farm payrolls expected to go up. So it's going to be really interesting on the average earnings and payrolls going up. So that kind of lends us to unemployment staying the same and job market staying strong. Well, let's see what the previous got revised to, because that's what I'm actually going to be looking. I'm not going to be looking at their forecast. I'm going to look at what their previous got revised to, because they've been doing that sneaky thing of revising the previous one lower and not everyone paying attention, just paying attention to the number. And as always, net speculative positions coming in there. So guys, we're going to dive into the debate section of the video.
So Mike, are we going to the Santa Claus rally or what?
Well, like I said in the beginning of the video, you were right. So I'll let you hear that from me. New 52-week highs. And I don't know, this wasn't covered. Did you know the Dow hit new all-time highs?
I thought we did, or no, I thought we covered that with the Nasdaq, not the Dow. But in regards to the S&P 500, I just took a look at the 52-week highs. When it comes to the S&P 500, we're less than 1,000 points away.
Yep,
we're like 900 points away.
I covered it was 1.4% to new all-time highs. Surprisingly, Nasdaq was kind of muted this week. But then again, tech could let other stuff, especially Russell. If you look at Russell, talk about middle finger candle on the day.
Yeah, the ones that definitely brought this whole thing up was the financial sector. Like if you take a look at XLF.
Oh yeah,
XLF. If you take a look at XLF,
I saw XLF.
Yeah, look at that.
But that's just parabolic. That's just parabolic like no tomorrow.
Here's the thing, though. That was mainly brought up by the regional banks. And a few of the other ones, too. But, like, you know, mainly the regional banks. Yeah. So, it's going to be interesting because, well, next week we got job numbers on Friday. Yep. Then after that, we got FOMC. And I believe inflation's CPI. Also on the 12th, right? I think.
Let me pull it up.
I think inflation's on the 12th.
Because they should have it posted by now, so we can take a look at that week.
Yeah, I'm fairly certain inflation's on the 12th, and FOMC is on the 13th.
Yep.
And so if we get job numbers coming down, if we get inflation coming down, and then following, Powell says, we're gonna do another pause, dude, we're going to reach 52-week highs like that week. Well, straight up.
I don't think that him saying a pause is going to do anything because they're already pricing it.
I think
in.
it is.
A pause is not going to do anything because they're already pricing it in. That's why in the last meeting we didn't have that like crazy reaction, except like their interpretation. But there was one comment about in his speech. I'm trying to find it here, but he basically said we're not talking about rate cuts.
Yes, I do remember seeing an article about that. I do remember seeing an article about that.
Does not need to be in a rush now. We are getting what we want to get. And
sure.
again, if we look at May, cuts.
They're expecting cuts, which again, we have talked about this on the channel. We do not want cuts.
Oh, yeah.
We do not want cuts. In fact, pauses are horrible. Cuts would just be like detrimental at that point. So yeah, that's yeah. But dude, with the FOMC in November, that I think sealed the deal. I said we're going to reach 52-week highs, and then me saying that and me actually believing that, I still sold covered calls and still got screwed by covered calls. But
on a company that you talk about fundamentally being super strong, and I was bullish on it. I'm like, well, he was right.
I was expecting it to maintain, around
hold on,
100 bucks.
Fact check here. You said, and I quote, that Crocs, when it starts running, it doesn't stop. So you went against your own advice.
Yeah, unfortunately. But here's the thing, though. At least in my defense, I had a call. I think, expiring in December, which then I had to roll because it went in the money instantly. Dude, if you take a look up Crocs, that thing gained 2 to 3%. Okay, that thing gained 2 to 3% every day since last Tuesday. Since like before Thanksgiving, it gained like 2 to 5%. It was crazy, absolute insanity. So yeah, I think we're gonna get a Santa Claus rally, dude. I think we're gonna get it.
We're in the Santa Claus rally right now. Come on, like this is the classic definition of Santa Claus rally.
Yeah, I said in the short term we're gonna reach 52-week highs.
But it doesn't matter what Powell says, because even if you look at his comments right here, Fed will raise rates again if needed to lower inflation. It's premature to say monetary policy is restrictive enough.
Which are you looking at? I don't know.
Right here, these two right here. But
okay.
And then uncertainty over economic outlook is unusually elevated. I'm like,
also inflation all the way to the top. The top one, inflation is eased. Core inflation is still too high.
Yeah.
So
because if you look, let's go back to this week, right? Let's go back to core inflation. Remember, these people are expecting like 1.5 standard core inflation, and you're at 3.5. I mentioned it in the going over the news in the beginning of the video that essentially it's going to take longer than these mongrels over here expect these cuts. Like September, if we look at it, they're expecting over 100 basis points in cuts by then.
Wow, 1%.
Which 1%. Here's the thing. Be careful what you wish for, because I don't know if you've been following it, because you really don't invest in bonds on like your 401k or anything like that.
I don't have a 401k.
Okay, but I invest in bonds in my 401k. I really don't touch it much. I was jaw smacked when I saw this. So I showed this in the beginning of the video. This is bonds. So for people that don't know what it is, all you got to really pay attention to is this number right here and the yield. Two numbers you got to pay attention to. So bonds are represented in $1,000 increments. So a 1 is $1,000. 1,000 is $1 million. So again, keep that in mind when looking at these numbers. This is 400 grand, $1 million, $350,000. So I'm going to keep scrolling, and I did this with the audience. So if anyone wants to skip forward, you tell me when you see a 1.
A 1 in that parentheses, right?
Yeah.
It's still going, buddy. Oh, 100. 100?
No, I said a 1. You got 100 grand rolling around somewhere, burning a pocket in your hole?
Wow.
Oh, 2 months ago, these all would be 1s. I could have bought any bond I wanted, and I'm still going.
So what does that mean? So what does
So
okay?
I
There's
got a 5, right? You
Yeah.
know,
So what does that mean though? Because again, I'm not.
Okay,
I
so-
know bonds, but I mainly know yields of bonds. Not
so it
necessarily
means
this.
one thing. Retail has been blacklisted essentially from the bond market. You cannot buy direct bonds on the bond market because the big players are so, pardon my French, screwed that they literally are only offloading them into other institutions. They're not letting retail participate in it, which coincidentally, the yield curve is starting to come right back down, heading towards the Great Depression inversion. So I'm like, Oh, and would you like me to throw like a Molotov on the fire as we're talking about it?
Go on.
What do you think reverse repo is doing?
Oh, is it like under 700 billion or something?
Well, look at the 20, the 30, and the 10. Remember, the reverse repo is to push liquidity into the bond market, but the bonds are increasing in price, meaning there's buyers. But what do you think reverse repo is actually doing?
I couldn't tell you. I
Well-
have not looked at it.
Well, I thought we were going to get like back to $1 trillion. That's what I thought, because I'm like, okay, if bonds pushing up, reverse repo flowing out, more incentive to buy. Logical.
Okay.
No, we're at 768,000.
That's what I said.
Yeah.
That's
But
what I said.
hold on.
Like-
We were at when Jerome Powell opened his mouth, we were heading back up to $1 trillion.
And then just instant
and
crash.
then
Wow.
we're all morons buying bonds and boink. So it's
Wow.
like literally insane. I'm like,
Well, I mean, we do have the perspective that this will all, or that the repo market, the reverse repo market, assuming that it continues its trajectory, it'll go to zero by Q2.
Yeah, I'm gonna say if it keeps doing these harder and harder dips because we're accelerating the slope, that June forecast may not be June. It may be May or April, regardless of which scenario we go to. But the bond market is just in such shambles right now that it's absolutely insanity.
Interesting. So, yeah, I mean, I wonder when this will become an actual problem. Like, you think under 500 billion, that's when they're going to actually make it a big deal?
I think once you start getting to $250 million, I think that's when you really start getting into it because you're only going to be a month or two out from the inevitable.
Okay.
But the other thing is, like, you have the debt ceiling negotiations coming up in January. It's going to be the government funding and debt ceiling combined in a negotiation. So that's going to be interesting. So what did I say the Treasury has to fight this problem in June? A gigantic stockpile. If they blow it because Republicans and Democrats can't get an agreement and they have nada and something catastrophic happens in the bond market, like China, Japan, Korea start selling more, Saudi Arabia start selling more of their U.S. bonds, forcing this money to go out of the reverse repo into the bond market to provide liquidity. Well, you may catch the perfect golden scenario of you're screwed out of your imagination that you're going to have government funding problems, the short-term bank lending program expiring in March, the Treasury being broke, the Fed being broke, and yeah, Armageddon. We're going to make 1929 look like a happy pool party when this is all over.
We shall see, right? We shall see. So, when it comes to the fear and greed index, I'm assuming that we are in extreme greed at this point, right?
Nope.
Or touching it.
Nope.
Oh, wow. We're not, okay,
Flat.
so we're a little bit... Okay.
A week ago, we were 66. Today, we're 67. It just kind of went nowhere.
But I mean, okay, but we're still on track for 52-week highs. But anyways, guys, that pretty much does it for this video. Make sure to like, subscribe, comment. It really does help here with the algorithm on YouTube. And with that said, peace out, and we'll see you all next time.